IPSAS 19's Provisions, Contingent Liabilities and Contingent Assets. IPSAS 19 based upon IAS 37's. If you are familiar International Accounting Standards 37's, then yeah, IPSAS 19's is not a new chapter for you. Overview of IPSAS 19. The life of an entity is full of uncertainties regarding future events, and therefore management is required to make informed estimates on the outcome of such events. For example, will there be sufficient demand for a service in the future? Will all the receivables be collected? If there is a chance that your receivable may not be collected in a full amount, then the management has to take some measure in the financial reporting for such future bad debts. IPSAS 19 discuss that future uncertainties. What is the main objective of IPSAS 19? Is to ensure that appropriate recognitions, criteria, and measurement bases are applied to provisions, contingent liabilities, and contingent assets, and that sufficient information is disclosed in the notes to the financial statements to enable users to understand their natures, timings, and amount. Scope of IPSAS 19 does not apply to provisions and contingent liabilities arising from social benefits. Social benefits should be excluded for the study purpose of IPSAS 19. What are social benefits? Social benefits refers to goods, services, and other benefit provided in pursuant of social policy objective of a government, like delivery of health, education, housing, transport, and payment of benefit to families and the aged, the disabled, the unemployed for supplement their incomes. Similarly, IPSAS 19 does not apply on construction contract as covered in IPSAS 11, or employee benefit IPSAS 39, income tax or financial instrument that will be covered in IPSAS 29. Now move towards the key definitions. Key definitions are very important. Provision is basically the uncertainty about times and amount. Then the question is how provisions are different from other liabilities. As you noted, in provision there is uncertainty about amount and times. Provisions are distinguished from other liabilities such as payables and accruals because there is uncertainty about the timings or amount of the future expenditures required in settlement. Key definitions of contingent liabilities. Contingent liabilities is a possible obligations that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. Might be the occurrence of any event in futures will decide whether it is contingent liabilities or not, or maybe the non-occurrence of any events in the futures will decide whether it is contingent liabilities or not. The occurrence of these events is not within the control of the entity. The second part of the definition is a present obligations that arises from past event but is not recognized because it is not probable that an outflow of resources. It is not probable. At this stage, it is not probable. There is a very little chance. And the amount of the obligations cannot be measured with sufficient reliability. You have not in positions to measure the amount. In provisions, you noted that there is uncertainty about the amount and time. You may be fixed amount 2%, 5%, 10% of the total amount, but there is uncertainty whether it will be 2%, 3%, 5%. This is in the case of provisions. Now in the case of contingent liabilities, you are not in positions to measure amount. You are not positions even to fix on 2%, 5%, 10%. You are not even in these positions. Contingent liabilities arises when there is significant uncertainty about the number of aspects regarding the liabilities. The giving of a guarantee to another entity that is in financial difficulty is likely to be a contingent liability. You give a guarantee of an entity who is in financial difficulty, but what will be occurred in futures, you are not positions to estimate it. The giving of a guarantee is basically a contingent liabilities. The key definition of contingent assets, it is same to contingent liabilities. A contingent asset is the potential assets that arises from past events but whose existence can only be confirmed by the outcomes of future events not wholly within the entity control. The same thing like contingent asset, not wholly within the entity controlled, and whose the existence of contingent assets and potential assets whose existence can only be confirmed by the outcome of future events may be the occurrence of any event in the futures. For examples, contingent asset would be where a hospital is in the process of taking a drug supplier to court in a claim for damages caused by inadequate labeling on the drugs. The decisions of the court will decide whether it would be a contingent assets, whether it would be a assets of the hospitals or not. If the court will decide in the favor of hospital, then the presently contingent asset would become the assets of hospitals after the decisions of courts. Now at this position, it is a contingent assets for the hospitals, and it disclosed in the notes that there is a case in the courts and the decisions will decide whether it will be our assets or not. After the definitions of provisions, contingent assets, contingent liabilities, now there is a time to find how to recognize all these, the recognitions of provisions, the recognitions of contingent liabilities, the recognitions of contingent assets. First of all, we discuss how to recognize provisions. IPSAS 19 states that a provision should be recognized when all of the following are true. An entity has present legal or constructive obligations as a result of a past event. Legal or constructive obligations. Number two, it is probable outflow of resources will be required to settle the obligations. And number three, a reliable estimate can be made of the amount of obligation. Reliable estimates, but there is still uncertainty about the actual amounts. But you have in the positions to calculate a reliable estimates, whether it be 2%, 5%, 3%, 10%. After the final outcome, you fix it on the actual percentage. Now it is a reliable estimate. In the cases of contingent liabilities, you are even not in a position to find a reliable estimate. Under all conditions are met, unless all conditions are met, no provision should be recognized. When all these three conditions are met, you have to fix a provisions in your financial reportings. Here we see present legal or constructive obligations. What is legal obligations? Legal obligations is an obligation that arises from a contract, legislations or other operations of law. And constructive obligations is an obligation that delivers from an entity's actions where by an established pattern of past practices published policies or sufficiently specific current statements. The past practices of an entity is basically a constructive obligations of an entity. Similarly, published policies and part B, as a result, the entity has created a valid expectations on the part of those other parties that it will discharge those responsibilities. The creations of valid expectations by an entity is also a constructive obligation that it will discharge its liabilities in the future, and there is no difficulty will be in that terms. See the example of constructive obligations. A retail store which has long established practices of allowing customer to return unwanted goods. Basically, the returns of unwanted good is the constructive obligations. Here is an important step that differentiates between the contingent liabilities and provisions. If there is a more chance that outflow is likely to occur, then you have to fix a provisions for that. But if there is a less chance, it is not probable that an outflow will occur, a contingent liabilities arises. You see here that when there is a more chance, then provisions is recognized, and when there is a very little chance, means it is not probable, then you have to fix a contingent liabilities. But contingent liabilities is not in an amount form. It should be disclosed in notes. It is not in the form of an amount. And the second step and the second point is also the same. When there is a reliable estimate cannot be made, it means that it's a contingent liabilities, not a provisions. Now, how to recognize the contingent liabilities? Recognitions of contingent liabilities. An entity should not recognize a contingent liability in the financial statements. Disclosures may be required depending on the likelihood of a statement of a settlement being made. If the settlement of the obligation is not probable and not remote, then a brief descriptions of the nature of the contingent liability should be disclosed along with an estimate of its financial effect. An indication of the uncertainties that exist and the possibility of any reimbursement. The contingent liabilities are not present in the financial statement, in the face of financial statement, like financial performance and financial positions. It should be disclosed depending on the likelihood of settlements. If it is not probable and not remote, then you should disclose in the notes. If the settlement of obligation is remote, no disclosure is required. It means that if there is a very little chance, mean around 1% or 2%, that contingent liabilities or liabilities will occur, it means that this is a very remote factors. In this case, you do not need to disclose it. Contingent liabilities may develop in a way not initially expected. For example, there is only 2% chance. You do not need to disclose it even. But this 2% increased to 15%. It means that it's now become a contingent liabilities. And when the contingent liabilities become probable, there is a chance that you have to pay in the futures against your guarantee. Then you need to fix an amount for a provisions. The likelihood of payments in the provision is more and in the contingent liabilities in less, and in the case of remote you do not need to even disclose it. For examples, a local government entity may have breached an environment law, but it remains unclear whether any damage was caused to the environment, where subsequently it becomes clear that damage was caused and remediations will be required. The entity would recognize a provisions because an outflow of economic benefits is now probable. See an example. In a trade deal, the export department of a government gives a guarantee to certain exporters that it will cover any cost that incurred due to a private sector supplier failing to meet its contract obligations. During the first year, the 2000 X1, the supplier is able to satisfy all the orders it receives on time and to the required specifications. Now, during for this year's the first year's no provisions, it is only a contingent liabilities. How? Because there is no defect in the contract. All the requirements are supplied satisfactorily. It is only a contingent liabilities because the export department gives a guarantee. Till the completion of that contract, against a guarantee, you had to disclose a contingent liabilities in your notes. See, during 2000 X2, the next year, the supplier experienced production difficulties and as a result, some orders are delivered late or to a low specifications. This caused the exporters to incur additional cost in sourcing replacement goods from an alternative supplier. Now you see that there is a defect in the completions of the contract in the supply of the products. Now provisions is recognized with reliable amount. The government department who gives a guarantee is need to recognize a provisions in the financial statement and fix a reliable amount. The loss occur in the provisions or in the providings of the goods. Against that, a provisions is need to be recognized in the financial statement. Recognitions of contingent assets. Contingent assets should not be disclosed in the financial statement, similar to that contingent liabilities. It should be disclosed in the notes. Where the inflow of economic benefit is probable, the financial statement should disclose a brief descriptions of the nature of the contingent assets and where practicable an estimate of the financial effect. This is the estimate of financial effect, not an amount of contingent assets. See these charts, and it is important for your exams. There is options 1, 2, 3, three scenarios. There are three scenarios. What will you do in the scenario 1, in the scenario 2, in the scenario 3? Let's see. Present obligation has a result of an obligations event. Now, whether your present obligation has a result of an obligating event? Yes or no? If there is yes, the next question is whether probable outflow, you have to pay something? Yes. Whether you are in positions to find a reliable estimate? Yes. It means that there is some amount you have to pay and their amount is also be estimatable. You have to you are in position to estimate amount. It means that you fix a provisions in the financial statement with an reliable amount, an estimate amount. This is in the case of scenario 1. Now see, present obligation has a result of an obligated event? No. Possible obligations? No. It means that there is a remote chance. It means that you do nothing. But if possible obligation, yes. But there is a remote, no. It means that around 10-20%. Then you have to a contingent liabilities. See here, present obligation has a result of obligating event, yes. Probable outflow, no. Outflow at this position, at the current moment, probable outflow, no. But only you give a guarantee. It means that remote, no. Contingent liabilities. When there is a more chance that is a probable outflow and there is reliable estimates, you fix the provisions. But in any cases, you do not in positions to reliable estimates, then contingent liabilities, or probable or less but not remote contingent liabilities. And in the last case, not probable and even remote, then you do nothing. In the previous part, we studied the overview of SAS 19s, then the important definitions of provisions, contingent liabilities, contingent assets. After that, we noted that how to recognize, when to recognize these items, provisions, liabilities, and contingent assets. Now this is a time to find the measurement methods. Measurement of an amount to be put in the financial statements. But in the previous part, you see that the contingent liabilities and contingent assets are not placed in the financial statement in the form of an amount. You only need to disclose the contingent liabilities and contingent assets in the notes, the ending notes of financial statements. Therefore, you only need to measure the provisions. The measurement of provisions is the only concern. When to measure? At the end of reporting periods. We need to measure the provisions at the end of the reporting period for the placement in the financial statement purpose. The outcome of events that occur after the end of the financial year should be taken into account in making estimates. It means that sometime after the end of financial year, but there is still time to issue the financial statement reports. Some events may occur. You need to consider those events in the finalization of financial statement. How to measure? For example, for a single obligation, where the best estimate is 10,000 and there is a 55% chances of expenditures being incurred, then the provision should be 10,000, not 55% of 10,000, because there is a 55% chances of that you need to pay. You have to pay 10,000 against your guarantee. It means that you fix a provisions of 10,000, not a 55% of 10,000, because there is a 55% chances that you have to pay against that percent. Where the provisions are being measured involves large populations of items. The obligation is estimated by weighting all possible outcomes by their associating probabilities. The name of this statistical method of estimation is now has expected value. Let's see, all goods, a unitary full owned trading subsidiaries that sells branded goods such as t-shirts, sports kits to students. All goods sold come with a 1 year warranty, and past experience has shown that 10% of items sold have a tendency to fade over time. It means that against that 10% you have to fix a 10% provisions of that amounts. For example, sales during a year was 990,000 and the cost of that goods was 790,000. You have to fix a 10% of 790,000 as a provisions, the expected value of provisions. These 10% come from your past experiences. Let's see another example. A government medical laboratory provides diagnostic ultrasound scanners to both public sectors and private hospitals on a full cost recovery basis. The equipment is provided with a warranty under which hospitals are covered for the cost of defects that become apparent during the first year of the purchase. The university gives a guarantee against its products. If minor defect were to occur in all scanners sold, repair cost of 1 million would be incurred against all the products. If major defects were occurred in the all scanners sold, the repair cost of 4 million would be occurred. Past experience and future expectations indicate that 70% of scanners will have no defects. It means that against 75%, you do not need to fix any provisions. Do nothing with this 75%. 20% will have minor defect. It means that 20% you have to fix a 20% of 1 million, because in the case of minor defects 1 million would be occurs against all the products, but when only 20% have minor defects, it means that you have to fix a 20% of 1 million, and 5% will have major defects. It means that the total cost of in the case of major defect is 4 millions for all the products, but only 5% from all the products have major defect. It means that you have to fix 5% provisions of 4 millions. Let's see, against 75% do nothing. Against minor defect 1 million multiplied by 20% is 0.2 millions, and against major defect similar, the total expected value of provisions is 0.4 millions. Now another important concept is discounting. You have to show the provisions amount in your financial statement, but where the effect of time value of money is material, the amount of provisions should be present value of the expenditure expected to be required to settle the obligations. It means that you fix a provisions of 1 million for the next 3 years, but the question is that whether you show this 1 million in your current financial statement. No, it should be a present value of that future obligations. How to find a present obligations? Present value of the future obligations. The formula of discounting is that 1 divided by 1 plus r whole bracketed by y. Y is the number of years and r is the amount of discounting factors. For examples, during December 2000 X1, hospital became involved in a complex legal case, and its legal advisor have advised the hospitals that they are likely to have to pay 1 million compensations in 3 years' times once the case is finalized by the courts. The hospital's policy is to discount provisions using a rate of 2.2%. You see that you have to pay if the case if the case will be final, you have to pay 1 million in the next 3 years time. It means that there is a time value of money for that 3 years. How to calculate 1 million, how to place a 1 million in your present financial statement, current year financial statements. And there is a discounting factor of 2.2%. Now put the value in your formulas. 1, the interest rate, the discounting factor is 2.2% divided by 100 is 0.022, and the 3 is the number of year. Now you see that it is 94%. It means that 94% of 1 million should be placed in the financial statements. Debit to operating expenses, and operating expenses is the part of statement of financial performance. And credit to non-current liabilities. Non-current liabilities mean that long-term liabilities. According to IPSAS, long-term liabilities is not a term. As per IPSAS, long-term liabilities name as non-current liabilities. Credit to non-current liabilities, provisions, and provisions goes to long-term liabilities, go to non-current liabilities, go to statement of financial positions. This is in the case of first year. And what will you do in the case of subsequent second years? Now there is a difference of 60,000. See the second years. Against you put the values. Now the number of years is 2, not a 3, because you are 2 years near to the finalization of outcomes. It is 96%. And when you calculate 96% of 1 million, it is 960,000. 940,000 is also a part of your financial statement of previous years. Now you only need to increase 20,000 in the subsequent second years. And this is in the form of finance cost, statement of financial performance, 20,000, and credit non-current liabilities, provision statement of financial positions, 20,000. This is in the case of second years. And the examiner was asked only for these 2 years. As we see in the definitions of provisions, the concept of future events, the occurrence or non-occurrence of future events. Now SAS say that it is possible that the amount required to settle an obligation will be dependent on the number of future events. For example, the effect of possible new legislation that may affect the amount of an existing obligations of a government or an individual public sector entity is taken into consideration in measuring debt obligations. Reimbursement. In some cases, an entity may be able to look to another party, such as an insurance company or a supplier under warranty, for reimbursement of all or part of the entity expenditure to settle provisions. But we only take the reimbursement amounts in the financial positions when the reimbursement is 100%. When the reimbursement is 100% okay. It means that it is when there is a virtually certain. In the case of reimbursement, when the reimbursement is virtually certain, it means that when there is a more or near to 100% chance that reimbursement will be occur, then the amount and the amount will be received, then the reimbursement is recognized. Whereas in the cases, see the example of reimbursement. And transport agency has a claim from a road user for a damaged vehicles caused by a pothole in the roads. The entity legal advisor to believe that it is probable that a settlement will need to be made of 10,000 in favor of a road users. However, in parallel, it is also probable that a counterclaim by the entity against their contractor for contributory negligence would successfully recover the damage. Now, see, a provision should be made 10,000 for the outflow of economic benefits. It's probable. It means that you have to pay a 10,000 to the road user. On the alternatives, the counterclaims against the contractors you made, you, but it is not only probable. So you do not recognize the reimbursement here. But if the court decides in your favor, then you recognize reimbursement in your financial statements. When this is only probable, it should be disclosed as contingent assets, only contingent assets. Changes in provisions. It is a question whether you change the provisions or not. Yes, you change the provisions. It may depend upon many factors. It may be a discount factor may be changed or any other new legislations affect your provisions amounts. The increase is recognized as interest expenses in the financial statement in the part of financial performance. Use of provisions, where you use your provisions. A provision should be used only for expenditure for which the provision was originally recognized. It means that provisions should only be used against the original recognized purpose. Onerous contract. What is onerous contract? And why we study onerous contract in this chapter? Basically, against onerous contract, you have to fix up provisions in your financial statement. Onerous contracts are those contracts in which your benefits are less than your cost. For example, you take a building on rent for 5 years, an agreement, and you have to follow that agreement. But after 3 years, you do not no longer need of that buildings. It means that the next 2 years are a burden for you. And against those 2 years rent, you have to fix amount of provisions in your financial statements. When making a best estimate of the provision for an onerous contract, the entity should take into account an estimates of any likely income that will be received under the contract. For example, the agreement allow you to sublet that buildings, and you have received some amounts against sublettings. Then in the case, the income, the subletting amount should be minus from that liabilities and only make a provisions against that onerous burden. See with the example, a local government entity into 10-year lease of a buildings. The annual rent is 36,000, but after 5 years you do not need that buildings more, and you sublet the building and you receive 24,000. It means that your burden is only 36 minus 24, that is 12,000 for the 5 years, the last 5 years. It means that the 12,000 multiplied by 5, it is 60,000 is the total provisions, gross provisions for the next 5 years. And you have to make a provision of 60,000 in the financial statement. But if there is a time value effect, you should discount it the 60,000 with present value. Restructuring. Again, the question is why we studying restructuring here. In the cases of restructuring, you also need to make a provisions in the financial statement. What is restructuring? Key definitions. A restructuring is a program that is planned and controlled by management and materially change others. The scope of activities. When in the form of any management decision, the scope of entity's activity change, it means that restructuring occurs. Or when the manner in which those activities are carried out are changed, it means that restructuring occurs. Example, termination or disposal of an activity or services, closure of a branch office, it means that you restructuring your office, changes in management structures. These are the example of restructuring. How to recognize? A provisions for restructuring costs is recognized only when the general recognition criteria for provisions are met. The basic two main criteria of recognitions. There is a probable outflow and there is a reliable estimates. What are the criteria of recognitions? A detailed formal plan has been made. Number one, there is a formal approved plan. And there, the organization has raised a valid expectation that it will carry out the restructuring. A restructuring should only include direct expenditures arising from the restructuring, not indirect expenditures. See an exile. An entity has a formal restructuring plan in place and has raised a valid expectation that this will take place by starting to implement the plan or by announcing its main features to those effects. Can this be recognized as valid provisions? Why? Let's see whether it is a constructive obligation. Yes, because there is a detailed plan. Whether it is a valid expectation. Yes, as we see. Now, provisions can be recognized in the financial statement with a reliable estimate amount. See another other. Can the following recognize the provisions? Number one, an entity offers warranties at the time of sale under which it agrees to make goods, repair or replace any items that develop manufacturing defects within 3 years. For the 3 years, there is a legal obligations and there is a probable outflow. It means that you have to recognize the provisions here. Number two, entity X guarantees certain borrowing of entity Y whose financial conditions is sound. Financial condition is sound means that at current position there is a little chance that you have to pay. It means that there is no provisions in the statement of financial statement, but against your guarantee you have to disclose a contingent liabilities in the notes, which should disclose that you gave a guarantee against borrowing of entity Y. In the case of number 3, an entity plans to repair certain of its assets next year. Next year means that features whereas the provisions and contingent liabilities and contingent assets are also relates to the past events. It means that you do nothing in the case of number 3. In the end of IPSAS, every IPSAS, there are some disclosure requirements. A number of disclosures are required in relation to provisions, contingent liabilities, and contingent assets. For a provisions, a full reconciliation should be presented, clearly identifying moments during the periods. These might include revisions of the estimates, utilizations of the provisions, or release part of the provisions. Similarly, you show that how the time value of money affect your provisions. An explanation should also be provided for each class of provision, detailing what the provision is for, expected time of value, outflow, indications of uncertainties about timings or amount of expected outflows, and whether any reimbursement has been recognized. And for contingent liabilities, assuming that expected outflow is not remote, a brief descriptions for each class of contingent liabilities should be provided. Estimate of financial effect, an indication of any uncertainties, and the likelihood of any reimbursement should be disclosed. Similarly, in the case of contingent asset, the entity should briefly explain the nature of the contingent asset and where practicable the financial effect of such an assets. Thank you. This is the end of your IPSAS 19's provisions, contingent liabilities, contingent assets. We studied in these chapters the overview of IPSAS 19's, why we study IPSAS 19's. After that, we studied the key definitions of provisions, contingent liabilities, contingent asset. The next, we studied how to recognize, when to recognize the provisions, contingent liabilities, contingent asset. After that, we measure the amount of provisions. We do not measure the amount of contingent liabilities, contingent asset, because contingent liabilities and contingent assets are not in the form of an amount. It should only be disclosed in the notes.